Hey everybody, welcome back. Brad Myers here again with Fulton County Homes right here in Fulton County, Ohio. 20-year home inspector turned real estate agent with Harmony Realty Group. Today I want to discuss renting a home versus buying a home. So stick around. If you like my videos, please subscribe to my channel and hit the bell down below so you're notified of my videos that come out every week. So I get this question quite a bit from my friends and family. They want to know if they should keep renting or if they should purchase a home. Well, I decided to make this video because there's a lot that goes into this decision.
Truly, you have a dizzying intellect.
Wait till I get going!
And of course, the number one thing to consider is can you afford to buy a home? There's more to consider than just making the monthly mortgage payments. For example, having an emergency savings account. I always try to stress to potential home buyers that they need to have at least 3 to 6 months worth of expenses saved in some sort of emergency fund. Having an emergency cash reserve is one of the most fundamental building blocks in good financial health. It should definitely come before any other investments, including home ownership. For example, if you're renting a home and the home needs a new roof, or it needs a furnace, or it needs a water heater, these are all things that the landlord takes care of. So having that emergency fund is pretty important when you first consider buying a home. Although you can buy a house with as little as 3% down, this also means you're going to be taking on a lot more debt. Unless there's an incredibly compelling reason to buy a house with only 3% down, I strongly recommend that you save up for at least 10 to 15 to 20% down. 20% down probably seems like a lot of money, but it's going to save you on interest, it's going to save you on PMI insurance, private mortgage insurance, and it's going to give you a much more stable financial footing as a homeowner. Okay, next thing to look at is your debt to income ratio. Lenders are going to look at your debt to income ratio from two different perspectives. One is your front end debt to income and your back end debt to income.
Please stop staring at my ass.
I wasn't.
Okay, so to calculate your front end DTI or debt to income ratio, divide your projected monthly expenses, mortgage payment, insurance, and taxes by your gross monthly income. And for your back end DTI, you're going to take all your housing expenses, your credit card payments, all your monthly expenses, and divide that by your gross monthly income. Most lenders are looking for a front end DTI to be at or below 28% and a back end to be at or below 33%. And if you're not quite there yet, I highly recommend waiting until you're in a stronger financial situation. Okay, next thing is credit score. Of course, the higher your credit score, the better chances you are getting a loan, and then also when you get that loan, having lower interest rates. For example, the difference between 4 and 5% on a 30-year interest rate on a $400,000 loan is almost $68,000. So it's definitely worth doing whatever you can to boost your credit score, even if it means waiting a little bit longer to buy your first home. Okay, so let's shift gears a little bit. Think about your 5-year plan. So let's assume that you're in a great financial situation to buy a home. Now you need to ask yourself where you want to be in 5 years. If the answer is a definite geographical location, you want to be in this certain area for the next 5, 10, 15 years, then buying a home right now may be a pretty good idea. But if you're not sure where you're going to be in the next 2 or 3 years, renting a home may be a better option. Not only does renting offer better flexibility if you decide you want to pack up one day and take off, it's also a little cheaper in the short run. I definitely only recommend buying a house if you know you're going to be in that house for at least the next 5 years. This will give you time enough to recoup the expenses of buying the home. For example, commissions and inspections and all the things that are involved with buying a home. For example, if your home appreciates 2% every year, then naturally it's going to appreciate 10% over the next 5 years. And then finally, home ownership can be very unpredictable and time consuming. When you rent a home, you know what your rent's going to be every month, and you know pretty much what all your expenses are going to be every month. However, when you own a home, 1 month you may not pay anything but the mortgage and your normal monthly expenses. The following month you may end up buying a furnace or a roof or water heater. And then owning a home is also very time consuming. Some of the things that you need to take into consideration are, do you like your weekends to yourself? Do you like your evenings to yourself? Or do you travel a lot? If so, the time commitments to owning a home may be a little bit more than what you want to take on. There's always going to be projects around the house that you're either going to want to take care of or need to take care of. For example, cleaning gutters or caulking windows or replacing a water heater or cleaning the furnace, And despite the added risk and the costs involved and the time constraints, most people prefer to be homeowners. So there you go. Definitely some things you need to consider before jumping into home ownership. If you guys have any questions, please comment down below. I love answering questions. Thanks for watching.